Good afternoon, everyone. Welcome to the Springboard Equity Education Series. Today's topic we're very excited to do in collaboration with our partners at the Rockies Ventures Club. Today's topic is understanding startup valuation, which will be led by Executive Director Peter Adams. Before we jump into today's topic, just a couple of housekeeping items. By the way, I forgot to introduce myself. I'll be your moderator. My name is Lyle Martin. I'm the CEO and founder of Springboard Equity. As we go through today's presentation, you will notice that on the right-hand side there is a chat box. If you have questions on anything for Peter, we will be doing a Q&A after the presentation, so please type in your question in the chat box and we'll address those at the end of the presentation. If we do not get to all the questions, a replay link of the presentation will go out, and we also will be following up with any questions that did not get answered directly with Peter. As you see on the slide, quick disclaimer just on the background here. And at this point, I'll jump into the introduction and we'll jump into the program. So today's speaker, as I mentioned from the Rocky Venture Club, is Peter Adams. Peter is the Executive Director of the Rockies Ventures Club as well as the Managing Director of the Rockies Venture Fund. And we were lucky enough to have Peter actually do a presentation for us a couple of months ago. And one of the topics that got a lot of interest in and addressed a lot of questions was around startup valuation. So we made that the topic of today's presentation. So without further ado, I will now turn it over to Peter. Thanks, Peter.
All right, thanks. Well, let's dive in. I've got a lot to get covered in 30 minutes. So, all right, well, let's dive in and do art evaluation for early stage companies. And just as a preamble, I want to say a couple things, and we can go to the first slide, by the way. A lot of people come to me and say it is impossible to value an early stage company or a pre-revenue company. And so hopefully 45 minutes from now, you will say, not only is it possible, but I have an idea about how it's done. So I've given this talk to the National Association of Valuation Consultants and Advisors. These are folks who do valuations on mature companies all the time, and they've found this fascinating to see all of the techniques you can do for early stage companies. So I'm going to give you just a taste of a few of these methods, and I'm going to show you how you can use them overall to come up with a defensible strategy. So the thing is, every time you are negotiating a deal, you need to have a valuation for your company. And so a lot of people want to put this off and try not to do it, but really it's something that must be done if you're trying to raise money for a company or if you're an angel or venture investor who wants to invest in a company. So the traditional valuation methods that those valuation advisors use don't work for early stage companies. They're going to have some sort of multiples of revenues or EBITDA or assets. And in our case, multiplying those would be like multiplying 0 times 0 times 0 and coming up with, $3 million. So it's kind of wacky math. But we'll walk you through that. So let's go to our next slide. And I like to start with this picture because it puts entrepreneurs in a mindset of presenting their company to angel or venture capital investors as one of many, many things that they're choosing from. A lot of entrepreneurs think of their deal as the only deal out there, and they kind of have this tunnel vision. And they should understand most investors are looking at like this, shelves and shelves of different loaves of bread with different qualities and different prices. And investors are investing in a marketplace, so they're choosing from many, many options. And so when you're presenting, some people say, well, you can't do valuation on early stage companies, so we just picked $10 million. Well, that's kind of like having a $100 loaf of bread, and that loaf is going to go stale on the shelf. So, the pricing, you can see some of these are on sale. It's to move them, to make them go fast. So the price and speed of getting funding done are closely related, and also just think about yourself compared to other companies who are out there raising money. So let's take a look at the next slide, which defines two ways of looking at valuation. And this is important for both investors and entrepreneurs to understand, is it's really about the present value of future cash flows. So, and that's the classic definition that anybody will use, and you'll hear maybe about DCF models, discounted cash flow models of valuation. But with venture investing, we're looking at future cash flows, but they're very different than with a traditional company. And if somebody who is looking for venture capital doesn't understand this difference, they're going to have a hard time communicating properly to venture investors. And the main reason is usually the typical startup company has negative cash flows for about 2.5 years. And even after that, it's going to be fairly minimal, and mainly because it's on hyper growth mode. So all of its money is going into marketing and growth. So when we talk about future cash flows, if I write a check to a company for $1 million, cash flow in year 1 is 0. My cash flow in year 2 is 0. My cash flow in year 3 is 0. My cash flow in year 4 is 0. And hopefully I'll have an exit or something in year 5 that might be something like 10 times my investment. So my cash flow then might be $10 million. So if you put that into Excel and you figure out, well, what's the discount rate that you need to do in this ultra high risk asset category, it's about 60% compounded. So that's how you get a 10x return in 5 years. So we'll talk about that in a few of the models that I'll show you as we move along. But understand that that's the typical discount for these things. And when you understand that, it starts to make it a little easier to figure out how you can work out your present value from those future cash flows. The second definition here is mutually accepted valuation between company and its financial backer or backers. And that basically says, hey, the market is going to decide. So we see a lot of companies who start out with a high valuation, they can't get funded, and it tells us that that was not the right valuation, and then they come to something more reasonable and they get funded, and that tells us maybe that was the right valuation. So let's move on to the next slide. And there are a lot of uses for valuation. Everybody always thinks about it just for raising money, but there's a lot of reasons other than that. And one is a lot of startups are using stock to pay their employees, and I see them making big mistakes in giving stock out to employees. They might just sort of casually say, all right, well, you get 2% or 5% or 3% or some number that's a percent of the company, and that's sort of a capricious and strange way to compensate somebody. So usually most startups are going to have some sort of a combination of cash and equity. And if they understand the value of the equity, instead of talking about percents of the company, which is really kind of an irrelevant number, they'd figure out the value of a share and then give the amount of shares that they wanted that would be representative of the compensation that was appropriate for that position. Other reasons using valuation would be driving company strategy, benchmarking against other companies, setting goals, and determining how much of the company you're going to give up when you raise money. So let's go on. So I also want to start out by sort of talking about convertible debt, which comprises a lot of early stage venture deals. And a lot of people have this mistaken feeling that convertible debt allows them to kick the can down the road on the valuation question. And 10 years ago, even 8 years ago, valuation or convertible debt would be done without a cap. But today, virtually no convertible debt deals are done without a valuation cap. And by that, I mean that we set a price above which the conversion will not occur. So if we say the valuation cap is at $3 million and 2 years go by and the next venture capital round is at $10 million, then the people who invested in the convertible debt note will convert at the $3 million cap. So this is just something to understand. If you're going to do convertible debt or equity, regardless, you have to come up with a valuation. And the one thing, I don't have a slide for this, but it's a pretty easy formula you should convert to memory, and that is that the valuation of the convertible debt cap is exactly equal to what the valuation would have been if it had been an equity deal. So 1x equity valuation equals convertible debt cap. And this is an important concept to understand for people who are putting together convertible debt deals. Okay, so let's go to the next slide. I just wanted to talk about pre-money and post-money valuations. This is a super common mistake for people to confuse these two things. When somebody asks a startup what their valuation is, what they mean always is their pre-money valuation. And the difference between pre-money and post-money is simply this, is if your company is worth $1 million and you haven't received any investment, then your pre-money valuation is $1 million. If you receive a $500,000 investment, then your post-money valuation is the pre-money plus the investment, so now it is $1.5 million. In this case, the entrepreneur still owns 66% of the company. And by the way, 33% is too much to give away in an early round. Most angel rounds are going to be somewhere between 20 and 25%. Okay, let's go on to the next. Okay, so this is a sample you can do in your head or really quickly. This is what we do when we're screening companies to see if they make sense in terms of moving through our process and being presented to investors. So this is all the information you need to do a quick and dirty valuation. So we know always the investor wants to make a 10x return on their investment in 5 years. And in this case, the entrepreneur wants to raise $500,000, and the projected exit strategy includes a $20 million exit. So if we know all of this information, we've got everything we need to know to come up with a valuation. So let's skip to the next slide. I guess if anybody wants to type a number into their chat, if they think they know what it is, that would be great. Otherwise, we'll just move into the answer. We'll give people like 5 seconds to do this, but it should be quick and dirty math. All right, let's move to the next slide. Okay, so here's how we do the math. $20 million is the future cash flow. We know that we need to make a 10 times return. So $2 million is the post-money valuation. So 2 million times 10 is going to be $20 million. And here's what throws people off is then we subtract the $500,000 investment. So $1.5 million is the pre-money valuation. I'll just walk you through that one other way really quickly. So imagine that it's $1.5 million pre-money. I put in my $5 million. Now the post-money is $2 million. If it goes to $20 million, now my $500,000 is worth 10 times that. So I get $5 million. So both $500,000 is 25% of the $2 million right when I make the investment, and $5 million is 25% of the $20 million I get when we have our exit. So this is a quick way just to think about how to do valuations based on exits. So let's move to the next. And the next. So this is the formula for discounted cash flows. It's really easy with venture capital. You don't actually need to know this formula because it's always 10x. And if you're doing a valuation on a mature company, you have to build in all sorts of things like control, what the cost of capital is, and all these other things. But in our case, it is super easy. So I just put this in here to show you a scary formula that you don't need to know. Next slide. So now I want to talk, I'm just going to take a little segue away from methodologies, and I'll take you back to the rest of them. But I want to talk about how you use these things in negotiating. So one of the principles that is really important to understand is this fallacy of anchors. So let's go to the next slide. In this book, Predictably Irrational, Daniel Ariely has a really cool experiment he does to show how when people are thinking about values of things, a lot of things that are irrational or not related to the actual value of the thing can come into play. And so this is important to understand when you're negotiating a deal. But here's an example. He took a large number of people in a conference room and he had them all write down their social security number. And the people with the top 20%, the 9s and 10s, 8s and 9s, they said that this wireless keyboard was worth $56. And those with the lowest said it was worth $16. So for the same keyboard, these people had a 300% variation, and it was based solely on the number that they had written down beforehand. So I bring this up because as I watch negotiations occur, there's this whole philosophy of who should say the number first. And if you understand this idea of anchoring, it says that if you are the one to say the number first, you can actually anchor the negotiation to your side of the number. And I've seen this go well, and I've seen it go poorly for entrepreneurs. We had one entrepreneur from India who had a startup with some just off-the-shelf software that he was going to sell in India, and he said, our valuation is $7 million. And what he was trying to do was anchor way high. Instead, he lost all credibility, and the negotiation was over, and he never got funded. Instead, what I recommend is when we get to the end, I'm going to show you how we'll come up with a valuation range. And what you want to do as an entrepreneur is to put yourself at the high end of that range, or as an investor at the low end of that range. But you always want to be in that valuation range so you get a fair deal for both sides. So let's go on to the next. So here's another thing that's really important to understand about valuation is getting the best valuation is not always the best thing for the entrepreneur. So we have this thought experiment where we say, if we know the actual valuation of a company is $1 million, which is best for the entrepreneur? They negotiate an equity investment at $975,000, leaving $25,000 on the table, or they get an equity investment at a valuation of $2 million, effectively double what the actual value of the company is. And I put this in here because people should understand that when you negotiate a deal, it's not just the value that you're negotiating. There are lots of other terms. So if we go to the next slide, here's a couple of common terms, and one is anti-dilution. I've talked about anti-dilution traps here. And if a company negotiates a valuation that's too high, and then the next round is actually lower than that valuation, then the anti-dilution clauses that are in most deals that are negotiated today are going to cause that entrepreneur to have to give stock to the early investors to make up for the overvaluation in the first round. So it can end up so that the founders end up with far less stock than if they had just negotiated a fair deal at the first point. But there are the typical term sheet is 3 to 5 pages of information, and it's really important for entrepreneurs and investors to understand these things very carefully. Things like liquidation preference, participating and non-participating can mean a difference of millions of dollars, just those two words. So we don't have time to go into those, but I just want to point out that valuation is just one part of a negotiation, and there's lots of other things that should be understood. Let's go on. So there is a lot of misunderstanding about dilution, and a lot of entrepreneurs try to have high valuations so that they don't get diluted early on. And I'll give you an example. Most deals have 2, 3, 4 rounds of funding, and the typical round is 20, 25%. At Rocky's Venture Club, we will never go over 30% on a round, so that's sort of our hard stop. A lot of people offer us 49% or big percentages, but that's for Shark Tank. People in the real world are going to want to do a fair deal that is good for entrepreneurs and for angels. But let's just go through this. You know, if there's 25% raised in the first round and 25% in the second, 25% in the third, what do you think the entrepreneur still owns as their share of the company? A lot of people intuitively think they're left with just 25%, but actually it's something like 38% at that point. They have a lot more equity, or no, actually that's 42% with the 325s. So they have 42% of the company after 3 rounds of 25%, and the reason is they're not selling their stock each time, they're selling the company's stock. So the first investor has 25% when he or she first invests. When the second investor invests, the first investor goes down to about 18%. So they dilute the other investors as well as themselves. And so the dilution is not so serious as one would think. Let's move on. So let's just talk about, I'm going to take you through 2 or 3 different valuation methods. And here's the principle I'm going to have you think about. We're dealing with extraordinary uncertainty in early stage companies. So how do you deal with that and coming up with a number that you're going to have valuation for your company? And what we've done is to look through literally hundreds and hundreds of different valuation methods. And we started putting them into buckets, and we realized that each one had its own problems and each had its own uncertainties, and it depended on certain data inputs. So what we said was, well, we're going to pick 5 that have totally different data inputs, and while each one of them might be weak on their own, if we take all 5 of them and then come up with the median and a mean and a standard deviation at the end, Now we'll have a fair negotiating zone for getting a deal done. So when you look at each one of these, I will readily admit each one of them will have weaknesses, but if you have 5 of them all together, they make each other stronger in aggregate, and you get a defensible valuation at the end. So let's take a look at the first one. So the burn rate valuation method is one that I'm starting with this because it seems the least intuitive. It seems crazy when you first look at it, but if you take a look at 1,000 venture deals, you're going to find that something like 90% of them work exactly according to this burn rate valuation method. So I said earlier that the typical angel round is about 20 or 25% equity. And if you think about all of these deals coming out about that same amount of equity, you can kind of think, well, gosh, if we're raising $500,000 and the typical deal is 25%, maybe this would be valued at such a way that it was caused my investment to be 25% of the company. So let's go through an example of looking at burn rate and how we can use that on the next slide. So if you're burning 25 grand a month and you need 18 months to get to the next major milestone, and by the way, that's what you should be thinking about as you think about how much you need to raise, is not buying runway, but buying milestones that will make you investable for Series A or for positive cash flow. So you figure out the total amount of cash you need, and in this case, it's going to be about $500,000. And so if you have $500,000 invested at 25% equity, you can calculate the value. Next slide. So in this case, it's just like the previous one. 500,000 is 25% of 2 million, so the pre-money valuation is 1.5 million and post-money is 2 million. So here we're using the amount raised to turn out what the value is. So here's an interesting question: is the total burn, is that equal to the raise amount? Well, when we look at a pro forma, we look at what the negative cash flow is, and we're going to sort of add up all the red at the bottom of the pro forma, and sort of see what are the milestones that have to be achieved, and then that's going to tell us how much we need to raise, and then what the percentage is. So you can't just say, oh well, we need to raise 5 million, so our valuation is $15 million. We would actually look at the norms for your industry and say, well, gosh, actually it's about 500,000 to accomplish what a normal company would take to do this. Next slide. So the next one is the venture capital valuation method, and this one is an exit-based method. So, and this one, by the way, I'll point out, only works if you're doing a single round of funding. We have another model that's more complex than this that shows aggregate dilution. We call it our cap table modeler. And it basically does the same method, but it might take you through 3, 4, 5 different rounds of funding, and it shows the aggregate dilution and net value at the end of the deal. But we're going to show you this one just because it's simpler and it's just one round. So let's say I'm going to invest $1 million. The next 5 lines here are modeling what the exit is going to be. So I'm going to look at the industry, the go-to-market strategy for this company, the growth potential, competition. In this case, we decide that the revenue in year 5 is likely to be $10 million with an EBITDA of $1 million. I'm going to research exits in this industry and see, what sort of multiples of revenue people are getting. So I'm going to look for 5, 10, 20 deals, and I'll come up with an average amount. In this case, 5 times revenues is what a typical exit is. So now we get a terminal valuation of 5 times the $10 million revenue, or $50 million in year 5. Now we just do that same math we did in the earlier one. What number times 5 equals 50,000, or excuse me, times 10 equals 50 million? It's $5 million. Subtract our $1 million investment, and our pre-money valuation on this deal is $4 million. Okay, next slide. All right, scorecard method. This one is working on a different method. It's looking at, instead of exits, it's asking what are other companies raising. So this is kind of like the loaves of bread, and it's sort of like real estate appraisals, where you say, we're doing comps with other houses, and we're saying some have more real estate, more bathrooms, more bedrooms, whatever. But in this one, we use something different. Next slide. So we start by figuring out what the average valuation for a company is in our market. And here, for this example, I'm using 3.5 million. Then on the left-hand side, I have weighting for team, opportunity size, product, technology, and so on. So those are the things other than square footage, bathrooms, or bedrooms that we use to value companies. So we say team is 30% of the value of the company. Now, in the next column, the 200%, that's where our evaluation comes in. We're going to have somewhere between 0 and 400%. And if it's 100%, it means it's just about average for most companies in the market. So in this case, we've got a team that's twice as good as the typical team in the market, good opportunity size, average product or technology. So we multiply these across, and we get an average of 1.6 times greater than the average company in the market. So we get a $4.875 million valuation for this company. Next slide. We have a risk method, which is based on the fact that as risk goes down, value goes up. And I'll show you how we do that on the next slide. We start with a baseline, just like in scorecard, so maybe $3.5 million, and we assess risk, and then we add or subtract points with $100,000 for each point. Next slide. So we look at different risk types. This list is a sample of some typical ones. Next slide. And we add +1, +3, plus or -3 for each of those. So we can have up to $300,000 plus or $300,000 minus for each risk. Next slide. So here's an example for a company. Excellent management team, we give them +3. Stage of business, maybe they're in early revenue, +1. Legislative political risk, not an issue, so a 0. On and on, lots of sales and marketing risk, -2. So next slide. Now we add up all those pluses and minuses, so we got +700 and -600. So the net is +$100,000. So we have our $3 million baseline plus $100,000, giving us a $3.1 million valuation on the risk valuation. Next. So a lot of people ask me, well, gosh, how do you determine these exit values? And this is a lot of the art of valuation. But there's a lot of science and research that goes into it. So it starts with a good pro forma, one that is believable, that's based on other companies who've gone through this before, on how the market, what the competition is, all of those things. We adjust future cash flows. Then we do a lot of research on who's acquiring whom and what the sweet spots are. Are they acquiring for 30 million, 100 million, 200 million? And then we look at the multiples, and then we look at who the potential acquirers are. So we do all of these things together to come up with those exit values. So next slide. So now we've done these 5 different methodologies. We put them all together. So we've got different values for each of these things. And here we've got an average of $5 million with a standard deviation of 646 and a median of just a little over 5 million. So what this tells us is our negotiating range here is pretty much $4.5 to $5.5 million. So if I'm an investor, I'm probably going to start offering at 4.5, and if I'm an entrepreneur, I'll start at 5.5, and then we'll go in and negotiate things from there. One thing I like about these methods that we've done is you can go into the meat of each of these methods. So I've seen investors just sort of go 4 million, and entrepreneurs go 6 million, and they just have these numbers. But if you can go in and say, well, I think the team should be 150%, and the opportunity size is 125%, you can do an analytical sort of negotiation as opposed to just doing the big number. So these tools can be used in a lot of ways to help you in negotiation. Next slide. So ultimately, valuation is all of this number work, but it's also a story. So you want to be able to tell a story that makes it convincing. And the worst thing you can do when an investor asks you what your valuation is to just blurt out a number. You want to provide just sort of a tweet or two about your rationale and then state the number, and you lead them to the conclusion as opposed to just dumping a number on them. Next slide. And if you think about it, your pitch deck is a valuation story. It's pretty much got the outline of what the scorecard method is. Who's your team? What's your market? What's your product? The exit opportunity, and so on. Next slide. So here's just a couple of quick things I want you to remember as takeaways. One is nobody has a single spreadsheet that is the one valuation method that's right. It's better to take a look at a bunch of them. Next. So also valuation It looks like numbers, but it's a balance of analytical and intuitive thinking. You're analyzing the quality of the team and the people and the markets and competition and where it's going. There's a lot you're doing. Next. Transparency is the best tool for coming to agreement. So rather than just starting with big numbers, you've got lots of tools where you can dig into the detail and negotiate based on the little things and then see where the big numbers come to. Prepare multiple valuations, play them off each other, way better than just doing one. And finally, exit strategy drives valuation. So if anybody tells you you don't need an exit strategy as a startup, they're telling you the wrong thing. And that's it.
All right. Well, thank you very much, Peter. As a reminder, everyone, please use your chat room. Type in your questions there. We will consolidate those, and we'll ask a few now while we have some time, and then we'll follow up with the remainder questions. So go ahead and please type your questions there. To get things started, we have a couple, Peter, that we'll go forward with, and it really just follows your last slide there around exit. So the question is, how does an investor size the likely maximum value at exit of the company in order to do their calculations?
So just like valuation, your exits are going to be a range. So we're going to look, I think probably the first thing we do is we start with the pro forma. And Dave Harris and I go through these things, and we'll analyze the pro forma, see if it's believable, and in maybe half the cases, we'll stay with the company's numbers. They know their industry, and they're believable. All the ratios look good, and we'll just stay with that. Other cases, we have to take our knowledge of industries and recast those. So it really comes to what we think, how big we think this thing is going to get, and then it's a factor of that plus what's happening in the market. And I always like to say a great CEO of a startup is like Wayne Gretzky, the hockey player, who said, he's a great hockey player because he goes where the puck is going and not where it is. And a CEO of a startup needs to know where the industry is going to be in 5 years and see who those entities are that would acquire them and create those relationships now so that they would be most likely to be approached for acquisition. So for the investor, it's the pro forma and the revenues, then looking at a bunch of comps to find out those multiples, and then looking at the opportunities and trends in the industry.
Okay, thank you. Next question. Can you please discuss standard liquidation preferences versus and participating preferred liquidation preferences?
Sure. So let's first define this. I just touched on that for a second in the term sheet slide there. So liquidation preference basically is a term that says that if there is a winding up of the company, either a good one that's an exit, or maybe we're only cashing out for $3 million because things didn't work out so well, it says that the investors who are the preferred shareholders get usually one time their investment back before anybody else gets anything else. So that's what a liquidation preference it is. It says the preferred stockholders get their money back before anything else happens. And the question is, what's the standard liquidation preference? And today it is 1x. So there you see some deals where people say 2x, 3x, 4 times their money back before anybody else gets their money. That's an unusual and onerous term. So usually 1x is the norm. And then the question is about participating or not participating. And this is a huge difference in terms of the amount of cash that a founder or an investor will put in their pocket. The norm is for non-participating. And what this means is that the investor either gets 1x their money back, or they get whatever their pro rata share is, 25% of the distribution. Participating means just that they get their 1x, and then they also get their 25% or whatever it is of whatever's left. So they're kind of double dipping with participating. So the norm, once again, is 1x non-participating.
Thank you. Next question. In your example, you were talking about overvaluating the company or under, and you gave the example of overvaluating the company of I think the gentleman from India and the technology. What are the risks and or upsides of a lower valuation?
So that's a great question, by the way. I mentioned Shark Tank. Sometimes those guys end up taking like 70% of the company in a round. And so one risk is if you give up 70% in an angel round, you don't have much left to go have follow-on rounds of investment. And if you've got something you want to get to be big, you might want to have enough powder left for 2, 3, 4 different rounds of investment. So that's why we say, it's a hard stop at 30%. We don't want to take more than that in a company, and we rarely even hit that. So that's a super important thing to think about. Undervaluing the company not only can cause you not to have enough equity later to raise more rounds, but it can also cause you to limit the amount of cash you can raise. So maybe you don't have enough to get to the next milestone, which is a huge risk. But that being said, I will say we had one company who came to us and we did our valuation models. We came up with $4.5 million for this company, and they said, "Well, we're raising at 3." We said, "Well, gosh, you could bump that up, maybe 4," which sounds strange for investors to say, but we want to have a fair deal. And they said, "Yeah, I know it's worth 4, but we're going to do 3 because even though the value is 4, we're going to price it at 3 because we need to raise this round quickly." So you need to understand this difference between price and value. And in this case, they had 2 giant clients with 120 users in each one of them, and they were able to raise this money in 3 weeks, close the deal out in 3 weeks, and onboard these 2 clients and be on to profitability. And we've done 2 rounds with them since then. So they were very smart in getting these clients who showed good traction and moving their company ahead rather than spending 6 months or 9 months raising the money.
Very good. So I think we've got time for one. Let's do one last question. And actually, I guess we have time for 2. So one is you had a list of, I guess, different factors that go into evaluation. How does something like the development stage of a product play into valuation? Meaning it's still in beta or it's been launched. So what stage of development, how would that play into evaluation?
Sure. So a bunch of different ways, and there's I'll give you 3 examples with different valuation methods. With the risk method, you're going to get a -3 on product because you've got technology risk. And usually when somebody comes to us, they've got a product just about ready to launch, and we're looking mostly at market risk. But if you have a high technology risk, that's going to ding you in your valuation method using the risk method. Scorecard method, same thing. You're probably going to end up with a 50%, so less than the average for product. So that's going to ding you, and that's the 3rd highest percentage. And then finally, with venture capital method, it's going to make you go farther. You might have a 7-year exit instead of a 5-year exit. And a 7-year exit is 25 times returns to hit that same 60% IRR. So now you're going to have to show your company can grow even bigger and bigger. So having a product that's too early, not enough traction, will definitely ding you in valuation. And most of the time, you're going to raise friends, family, and fools rounds for $25,000 to $250,000 before you come to angels or VCs anyway, just so you don't have that issue.
Very good. Last question, and thank you so much, Peter. This has been fantastic. Last question is, how critical is it for a company raising funds to outline their subsequent raises?
So this is one that there's a lot of confusion on. We'll ask people, hey, are you going to have future rounds so we can model this out and understand what they see their milestones to be and how big they expect to be, what their uses of capital are. And if you don't know those future rounds, it makes it hard to model what your overall dilution is going to be and what your capital strategy is. So we say that a company should definitely know all of their future raises and their exits. So if they're raising $1 million today, and $3 million in 24 months, and $10 million, at 48 months, then that's great. That's a normal set of raises, and maybe they'll exit at $80 million. And you can model that out, and each of those 3 investment tranches, the investors, you can make sure that they're going to get the types of returns that they need to get to meet their goals. So I would say somebody who is saying that you can't know what you're going to need in the future is usually a naive first-time entrepreneur. Somebody who's done it or is working with good advisors will be able to come up with reasonable scenarios. And they may change. You may need more capital because you're really blowing and going and doing great. And you obviously want to be able to change your strategy, but you should always have all of your future raises mapped out as well as your exit, so you can model the valuation using that.
Very good. Thank you so much, Peter. Thank you for all the insightful information. Participants, thank you for joining. That concludes our today's webinar. As we mentioned, any questions that came in or continue to, we will follow up with responses to those. And the link or the replay of this webinar will also be posted, and you'll receive a copy of that. So at this point, thank you very much, everyone, and have a wonderful day.